Welcome back to the Gold Standard. I'm Marcus.
And I'm Sasha. Marcus, gold just hit its highest mark in 2 months.
It did. And the number behind that move is more interesting than the headline.
We'll get into what's fueling it, plus a couple of big bank forecasts sitting way out past today's price.
After that, we're crossing into silver, where Citi's got a call that's turning heads across the desk.
$90 an ounce is the number. We'll see if the case behind it actually holds up.
There's also a shakeup on the mining side, a merger that just changed who's the biggest gold producer in North America.
And a couple of smaller miners are pouring fresh money into exploration right now, too.
Right. We'll weigh whether that kind of exposure beats just holding the metal itself.
And later, a $10 million find with a genuinely strange backstory.
Right. Plus, a scam warning worth sharing with anyone in your life who invests.
Okay, real talk, that last one is wild. Marcus, where do we start?
Let's follow the gold. It started moving the second inflation data came out Wednesday morning. Gold just touched a 2-month high after Wednesday's inflation data came in soft. Reuters tied the move directly to traders cutting rate hike bets.
Okay, real talk. Walk me through that. Feels backwards. Most people think hot inflation is gold's best friend, not cool inflation.
It's really about real rates, not inflation by itself. A real rate is just the interest rate minus inflation, which your cash actually earns after prices eat into it.
So if inflation cools but the Fed doesn't cut yet,
it really should climb, and that usually hurts gold. But traders are betting the Fed cuts sooner now, so expected real rates are falling instead. Gold pays no coupons, so when cash yields shrink, holding metal costs you less.
But what does that actually mean for someone with a brokerage account, not a trading desk?
It means gold stops getting punished for sitting there earning nothing. Think back to late 2008 when the Fed slashed rates towards zero. Real yields fell off a cliff and gold ran from under $800 to north of $1,900 over the next 3 years.
That's a big move off one rate story.
History doesn't repeat, but it rhymes. Nobody's calling this 2009 again, but the mechanism is the same one working right now.
So give me the actual number. Where's this heading?
Kitco surveyed the LBMA analysts, 16 of them in July, and even with gold dipping under $4,000 that month, their average year-end call landed near $4,500.
And the high end of that survey?
Their most bullish respondents said $5,100.
UBS has a call in here too.
They see $5,000 challenged in the first half of 2027. Kitco reported the bank's note points to lower real rates, a softer dollar, and strong sovereign demand.
Sovereign demand. For the folks at home, that's central banks.
Right. And Yahoo Finance covered a fresh wrinkle there. OMFI flagged central banks buying more gold than dollars for reserves for the first time it's tracked that comparison.
Wait, more gold than dollars? First time ever?
First time OMFI has measured it that way, yes.
Okay, but should regular investors just copy that behavior? Buy gold because a central bank is buying gold?
That math works differently at their scale. A central bank is repositioning trillions over decades. You're deciding what to hold going into next year.
So copying the trade without copying the time horizon is where it falls apart.
That's the risk in following it blindly.
Then what's actually going to decide if this rally sticks?
Business Insider made the point this week that it isn't central banks or momentum traders. It's whether Western ETF buyers keep showing up. European investors have been leading that return so far.
So the whole 4,500, 5,000 case rides on regular buyers not getting cold feet.
That's the real story here. Returning demand, not the headline forecast.
Which makes me wonder, if gold's whole case depends on that money coming back, what happens when it starts chasing something with a lot less supply sitting around?
Silver's the one people are actually buzzing about. Citi says it could hit $90 in the next 6 to 12 months.
That's a big jump from here. What's actually driving that number?
Seeking Alpha's coverage of the Citi call is specific. Investment demand takes over as the primary driver, while industrial demand actually softens.
That's the part worth sitting with. Solar panels, electronics, industrial buying has carried silver for years. If that's cooling and the price still runs, something else is doing the lifting.
Investment demand is doing the lifting there. Yahoo Finance ran the same Citi note, tying it to a less hawkish Fed and easing geopolitical tension rather than a supply squeeze. That's your transmission mechanism right there.
And that changes how sticky this rally is. Industrial demand doesn't vanish overnight. Investment flows can reverse in a week.
Switching gears, CME is opening round-the-clock trading on 100-ounce silver futures starting in September. Mining.com had that story this week.
Crane's Chicago Business covered the retail side of it. Traders can now bet on silver outside the old market hours, not just the New York session.
What does that actually change for someone sitting on physical silver?
Gap risk shrinks. Right now, something happens overnight, a currency shock, geopolitical flare-up, and you wake up to a price that already moved without you.
So no more Sunday night surprises.
Fewer of them, but round-the-clock trading also means round-the-clock volatility. Right. No closing bell to let things settle. That cuts both ways if you're not watching screens at 3 a.m.
And the number getting louder than cities. FX Empire's floating $100 silver on the AI and solar demand if it clears $72.
I think that overreaches on timeline. AI data centers use silver in some components, but the volume isn't close to what solar already consumes.
So it's more story than number right now?
Right now, yes, it's a real trend, but asking AI demand alone to push silver to $100 asks one piece of the market to do the whole job.
So don't buy silver because of your GPU. Not the reason I'd lead with. Watch the investment flows Citi's pointing at. That's the more measurable driver.
Speaking of chasing capital, the mining side is running its own version of this scramble.
Which brings us to who's actually consolidating to catch it. Building on that scramble for capital, gold miners are consolidating fast. Equinox Gold just merged with Orla Mining, and Streetwise Reports says the combined company is now North America's senior gold producer, targeting 1.1 million ounces of annual output.
Senior producer, what does that label actually buy you?
It's a size threshold. Cross it and borrowing costs usually drop, and you land on the index's generalist funds track automatically. Passive money follows the label.
So the deal is as much about the balance sheet as the ore.
Mostly it's about who answers the phone when a pension fund wants gold exposure.
And this is happening right as gold sits near that 2-month high. Timing matters here.
Not a coincidence. Companies do deals when the metal's up because their stock becomes expensive currency to pay with. Bloomberg reported Tuesday that Fortuna just committed $200 million to expand its Senegal gold projects.
$200 million into West African exploration. That's a signal. When institutional players commit capital at this scale, they're betting the price holds elevated long enough to justify the premium.
And it's not alone. America's Gold and Silver told Pulse 2.0 it's spending $45 to $60 million on growth and exploration next year, calling it the largest drilling campaign in company history at its Galena complex.
So walk me through this. If capital's pouring into miners this hard, are the stocks actually outrunning the metal itself? Operating leverage at play.
They are. Barchart covered this. Miners have rallied harder than bullion in the recent rebound because they carry operating leverage. A 10% move in gold can turn into 30 or more on the equity.
Wow. Great on the way up.
Brutal on the way down. Fixed costs don't shrink with the spot price, so margins compress fast on any pullback.
So for a normal portfolio then, bullion or the miners?
Depends on the job you want the asset to do. Metal is the store of value. No mine flooding, no strike risk. Miners are a leveraged wager on the same trend with company-specific risks stacked on top.
So it comes down to how much risk you actually want to carry more than which one wins.
Right, and size the position accordingly.
Speaking of risk chasing this rally, up next, a $10 million gold hoard turning up under a Belgian brewery, and the phone scams working overtime to separate regular people from their savings.
Shifting gears, there's a buried treasure story. The New York Times reported crews renovating a former brewery site in Belgium pulled up gold worth $10 million.
$10 million? Just sitting under a brewery?
That's the reporting. And here's the interesting wrinkle. Who actually owns it? Under most European civil codes, a find like that typically gets split between the person who dug it up and whoever owns the land.
So the construction crew doesn't just pocket it and walk?
Not usually, no. Belgian authorities are still working through exactly how this one gets divided.
Okay, that's the fun version of a gold story. There's a much darker one this week. Spectrum News, reporting from state police, says gold is now the trending scam of the summer, right alongside crypto.
And there's a specific case tied to that. Yahoo's Milos Komnenovich wrote it up. A 93-year-old man in Florida wrote a $600,000 check to buy gold after a caller convinced him his bank account was at risk.
$600,000.
A deputy caught it before the transaction cleared, got every dollar back. Gold manias and gold fraud have always traveled together. Every time prices spike, the scam calls spike right behind them. That's not new, it's just louder this cycle.
So what should people actually watch out for? Give me the concrete version, not the vague warning.
3 things. First, nobody legitimate cold calls you telling you to move retirement savings into bullion today.
Red flag number 1.
Second, a real dealer does not send someone to your house to pick up metal or cash. That's a courier for a scam, not a transaction.
And the third?
Pricing, that's the third one. A legitimate dealer quotes against the published spot price and shows you the math. If someone won't tell you how they arrived at a number, walk away.
Show me the receipts, basically. Show me the spot price you're pricing off of.
Exactly that. And think about it this way. If a call creates urgency, today, right now, before the market moves, that urgency is the product they're selling, not the metal.
One deputy, one afternoon, and a family kept its $600,000. That's the version of the story that actually matters to somebody's Thanksgiving table.
It is, and it's worth remembering next time gold's all over the headlines for the right reasons. So that's the real rate story. Falling yields doing more work than the inflation headlines. Something to keep watching into next year.
And that scam warning stuck with me. If someone calls asking you to wire cash for gold today, just hang up.
Exactly. And the miners versus bullion question isn't settled either.
Leverage cuts both ways, right?
Right. Sasha, what's tonight's takeaway for listeners?
Check the source before you check the price.
If this episode helped you make sense of the metals, subscribe and leave us a review.
Got questions? Send them to goldstandard@heymato.com. We read everyone.
Thanks for spending this hour with us.
We'll be back next week with more numbers, more context.
Take care of your portfolio.
And take care of yourselves. See you then.